mix of stocks and bonds. Generally speaking, it's supposed to get a little bit more conservative of a mix as you get close to retirement. Given what's happening in the bond market, and a lot of people are saying the bull market in bonds is over, how does that change your approach to finding conservative investments, if at all?
Right. No, that's a great question, and it's something that's coming up a lot more with the plan sponsors we talk to, with the investors we talk to, and the fiduciaries, the consultants that talk to them. A lot of concern over fixed income because a lot of the kind of the first draft or target date 1.0, so to speak, really relied almost blindly on reducing your equity exposure and increasing basically long fixed income. So there's a lot of risk, a lot of concern. Tapering is another big concern. So rates really have one place to go. And if you think about the type of investor that's really going to be saddled with that big burden of a large fixed income exposure, close to retirement, it can pose a lot of risk. So we've always been aware of that. We designed our products in a way that really look at what the world looks like. So we're not just looking at equities and fixed income. We also incorporate cash in that as well. We'll start to turn towards cash as a very strategic investment in those kinds of times when rates start rising. But a good question. It is something that really poses a lot of risk in the target date space for those people that are really getting close to retirement.
Would you move toward more speculative fixed income, or is that an area you'd rather go in cash than junk bonds?
You know me, and that would not be something that we would do. We tend to be a bit more conservative, particularly as you get close to retirement. So absolutely, there are some providers that are starting to move into just the search for yield. It's been a tough time in the markets. So you do see a real push for more yield, and you see people moving into emerging markets debt, high yield, other asset classes to try to boost those returns. It's been very challenging for those lower risk portfolios. We would not do that because you really have to be aware. It's not just the amount of equity that you have that really poses the risk for those people, specifically close to retirement. Those are very volatile asset classes when you get into those, and so you're really adding a lot of volatility and potential downside volatility because they tend to a lot of times act like equities when the world kind of falls apart.
Right.
And so we're very cautious about that.